Empty Porsche showrooms across the country, production lines grinding to a halt, dealers panicking as inventory piles up like automotive graveyards. The Stuttgart icon that survived 2 world wars and built empires on precision engineering, suddenly hemorrhaging cash faster than a blown head gasket. The headlines hit like a sledgehammer. Porsche officially closes operations. 99% profit collapse reported. The German luxury machine that printed money for decades, now bleeding out on financial life support. But here's the brutal reality nobody's telling you. No, Porsche hasn't physically shut its doors. But a financial earthquake just rocked the luxury car world that's about to crater your wallet, whether you own one of their cars or not. The damage spreads fast. This isn't just another corporate earnings miss. This is the luxury automotive bubble finally bursting. And if you own any premium vehicle or you're thinking about buying one, what I'm about to show you will change everything about how you approach car ownership. Your repair bills are about to explode. Resale values are crashing. Parts availability is tightening. The entire ecosystem that kept luxury cars running affordably just collapsed overnight. Let's rip apart the numbers that automotive journalists are too scared to explain honestly. Porsche's third quarter results aren't just bad, they're catastrophic. Operating profit dropped from 4 billion euros to 40 million euros. That's not a decline, that's financial carnage. We're talking about a company that used to print money faster than the Federal Reserve, suddenly unable to turn basic profit on luxury vehicles selling for 6 figures. Global deliveries crashed 25% year over year. But the real story is what's happening on dealer lots, cars sitting 90 days or longer, inventory backing up like a clogged drain, dealers who used to have waiting lists for 911 models now offering discounts just to move metal. The EV segment is bleeding money like a severed artery. The Taycan was supposed to be their Tesla killer. Instead, it's become a money pit. Battery costs are destroying margins. Production delays on the Macan EV are burning cash faster than they can raise capital. Here's what really scares Volkswagen Group executives. Porsche was their cash cow. That's the profit engine that subsidized everything from entry-level Golfs to Bentley development programs. Now that engine is sputtering toward complete failure. Now, compare this to other luxury brands, and you'll see the same pattern. BMW's margins compressed 40% in their premium segment. Mercedes is cutting production on S-Class and AMG models. Audi postponed 3 new model launches indefinitely. This isn't isolated corporate mismanagement. This is systematic market collapse hitting every luxury automaker simultaneously. The Chinese market abandoned German luxury for domestic alternatives offering better technology at half the price. US buyers rejected $100,000 electric sports cars with limited range and charging headaches. European customers can't afford luxury vehicle payments with interest rates hitting mortgage levels. But here's the part that should terrify every luxury car owner. Porsche's financial crisis creates a cascading failure that hits your maintenance costs, parts availability, and resale values immediately. When automakers slash supplier orders, parts become scarce and expensive. When dealership networks restructure, authorized service locations disappear. When warranty programs get revised, coverage gaps appear exactly when you need protection most. The luxury car investment myth just died. For decades, enthusiasts justified premium purchases by claiming certain models hold value or appreciate over time. Those days ended when Porsche reported near zero profitability on vehicles that cost more than most people's houses. We're seeing Taycan owners losing $40,000 in depreciation within 3 years. 992 generation, 911 service bills doubling as parts become scarce. Extended warranty claims being denied on technicalities that didn't exist when the coverage was purchased. The brutal truth is luxury automakers built their business model on artificial scarcity and premium pricing. When economic pressure forces them to discount heavily, or when competitors offer superior technology at lower prices, the entire value proposition collapses. Porsche's 99% profit collapse signals the end of an era where German engineering commanded automatic premium pricing. Chinese manufacturers now produce luxury vehicles with better software, comparable build quality, and half the ownership costs. This financial earthquake isn't just hitting Porsche, it's reshaping the entire luxury automotive landscape. And if you own any premium vehicle or you're considering buying one, the next few sections will show you exactly how to protect yourself from the financial wreckage heading your way. The repair bills are coming, the depreciation wave is building, the parts shortage is already starting. But if you understand what's really happening behind these corporate earnings reports, you can position yourself to survive and even profit from this luxury car market collapse. Porsche made the biggest strategic blunder in their 75-year history. They bet everything on electrification and lost spectacularly. The Taycan was supposed to be their Tesla killer. Instead, it became a financial black hole that's sucking the life out of their entire operation. Here's what really happened behind the marketing hype. Porsche executives looked at Tesla's stock price and decided they needed to go all in on electric. They poured billions into battery technology, retooled production lines, and promised investors that electric Porsches would maintain the same profit margins as their gasoline counterparts. The Taycan cost Porsche nearly as much to build as they sell it for. Battery pack expenses alone eat up 40% of the vehicle's retail price. Add in research and development costs, production line conversion expenses, and dealer training programs, and Porsche is essentially giving away a $100,000 sports car for free. But the bleeding doesn't stop there. The electric Macan launch turned into a production nightmare. Battery cost overruns are destroying margins faster than executives can cut other expenses. Delays in software development pushed the launch timeline back 18 months while fixed costs continued burning cash. Chinese competition is eating their lunch with better technology at lower prices. BYD and NIO are producing luxury electric vehicles with superior range, faster charging, and more advanced software systems. Chinese buyers who used to wait months for a Porsche allocation are now choosing domestic brands that offer more capability for half the price. And consumer rejection of $100,000 electric sports cars with limited range caught Porsche completely off guard. Enthusiasts who dreamed of owning a 911 discovered that electric alternatives couldn't deliver the driving experience they expected. Range anxiety killed weekend road trips. Charging infrastructure gaps made long-distance travel a nightmare. The brutal reality is that electric sports cars don't work for the core Porsche customer base. Track day enthusiasts discovered that battery packs overheat after 15 minutes of hard driving. Weekend canyon carvers found themselves stranded when charging stations were offline or occupied. Daily drivers realized that apartment living makes home charging impossible. Internal tensions at Porsche are reaching a breaking point as the company reverses its entire electrification strategy. Engineers who spent years developing electric powertrains are watching their projects get canceled. Marketing teams are scrambling to explain why the brand that promised to be fully electric by 2030 is now developing new combustion engines. The upcoming 718 replacement was supposed to be electric only. Now it's getting a gasoline engine option because market demand for electric sports cars collapsed. The new entry-level crossover planned for 2028 was designed around electric architecture. Now it's being redesigned for hybrid powertrains because pure electric luxury vehicles can't turn a profit. These strategic reversals aren't cheap. Porsche expects extraordinary expenses of 2.7 billion euros just to undo their electrification mistakes. That's money being pulled directly from research and development budgets for future gasoline models, parts supply chains, and dealer support programs. The cascading effects hit your wallet immediately. Taycan owners are discovering that battery replacement costs exceed the vehicle's resale value after 5 years. Charging infrastructure problems make long-distance travel impossible without detailed route planning. Software updates that brick essential vehicle functions can't be fixed at independent repair shops. But here's the part that affects every luxury car owner, not just Porsche customers. When the industry leader in premium automotive profitability admits their business model no longer works, it signals systematic problems across the entire luxury vehicle market. BMW is quietly walking back their electric Mini and I-Series expansion plans. Mercedes postponed EQS production increases indefinitely. Audi canceled 3 electric model launches after watching Porsche's electrification strategy implode. The luxury electric vehicle market that was supposed to generate premium profits and sustainable growth just proved to be a financial mirage. Automakers who bet their futures on electric luxury vehicles are now scrambling to develop exit strategies before they follow Porsche into profit collapse. This isn't just about one company's strategic mistakes. This is about the entire luxury automotive industry discovering that electric vehicles can't generate the profit margins necessary to sustain premium brand operations. The financial earthquake that started with Porsche's electrification gamble is about to reshape how every luxury automaker approaches product development, pricing strategy, and customer expectations. The damage spreads fast when industry leaders admit their core strategy was fundamentally flawed. The Porsche dealer network is imploding in real time. Cars are sitting on lots for 90 days or longer while dealers burn through cash. trying to keep their doors open. I'm talking to dealers who've never seen inventory move this slowly in their entire careers. Here's what's really happening behind those pristine showroom windows. Dealers are freezing new vehicle allocations because they can't move existing inventory. Floor plan financing costs are crushing margins as interest rates hit levels not seen since the 1980s. A dealer who used to turn inventory every 30 days is now looking at 120-day cycles while paying carrying costs that eat up any potential profit. The numbers are brutal. Discounting on new Porsches hit record highs last quarter. Models that used to sell at sticker price or above are now moving with $5,000 to $10,000 rebates. Certified pre-owned programs are offering incentives that didn't exist 6 months ago. When Porsche dealers start discounting, the crisis runs deeper than corporate earnings reports suggest, but the real carnage is happening in service departments. EV complexity is destroying traditional repair workflows. Technicians trained on combustion engines are struggling with high voltage systems that require specialized certification and equipment. Warranty claims on Taycan battery packs and charging systems are exploding faster than dealers can process them. Parts supply chains are tightening as Porsche cuts supplier volume orders to manage cash flow. OEM components that used to ship within 48 hours are now back ordered for weeks. Independent repair shops can't source genuine parts at reasonable prices because Porsche is prioritizing their own dealer network, which is already overwhelmed. Service departments that used to generate steady profit margins are now bleeding money on EV repairs that take twice as long and require expensive diagnostic equipment. A simple software update on a Taycan requires dealer-specific tools that cost more than most independent shops make in a month. Battery diagnostics need specialized training that most technicians don't have. Authorized service networks are being restructured as Porsche tries to cut operational costs. Smaller dealers are losing their service authorization because they can't justify the investment in EV repair equipment. Rural markets are being abandoned entirely as the company consolidates service operations into major metropolitan areas. I've seen dealers who've represented Porsche for decades suddenly facing franchise termination because their sales volumes dropped below minimum thresholds. These aren't fly-by-night operations. These are family businesses that built their reputation on Porsche quality and service excellence. The inventory nightmare gets worse when you understand the financing side. Dealers borrowed money to stock vehicles they expected to sell within 30 days. Now they're carrying that debt for 3 or 4 times longer while the vehicles depreciate on their lots. Floor plan financing that used to cost dealers a few $100s per vehicle is now eating thousands in carrying costs. Staff cuts are accelerating across the dealer network. Sales teams that used to manage waiting lists are now cold calling previous customers trying to move inventory. Service advisors are being laid off as appointment volumes drop. Parts departments are consolidating as smaller dealers can't justify full-time staff for reduced order volumes. The cascading effects hit you directly when your local Porsche dealer cuts service hours, eliminates Saturday appointments, or stops stocking common maintenance parts. Extended warranty work gets delayed because dealers can't afford to front repair costs while waiting for manufacturer reimbursement. Here's the part that should terrify every Porsche owner. When dealer networks contract, your vehicle's resale value drops immediately. Buyers avoid brands with limited service availability. Insurance companies raise rates when authorized repair facilities become scarce. Extended warranty coverage becomes worthless if no local dealer can perform the work. The dealer crisis isn't just about Porsche corporate profits. It's about the entire support ecosystem that keeps luxury vehicles running reliably. When that ecosystem collapses, your ownership costs explode while your vehicle's value craters. The damage spreads fast through every aspect of the luxury car ownership experience. The Porsche financial collapse isn't some distant corporate drama. It's about to hit your bank account like a freight train, whether you own a luxury car or not. The depreciation shockwave is already building momentum, and it's going to crush resale values across the entire premium vehicle market. Here's the brutal math. Used Porsche values are dropping 15 to 30% in real time. A 2020 Taycan that sold for $150,000 new is now struggling to find buyers at $90,000. That's not normal depreciation. That's financial catastrophe for anyone who bought one thinking German engineering holds its value. But the bleeding doesn't stop with Porsches. When the luxury market leader admits their business model is broken, it drags down every premium brand. BMW M cars, Mercedes AMG models, Audi RS variants, but they're all getting hammered by the same depreciation tsunami. Buyers are walking away from $100,000 vehicles because they know better deals are coming. The maintenance cost explosion is just getting started. Original equipment manufacturer parts are becoming scarce and expensive. as Porsche cuts supplier orders to manage cash flow. A simple brake job that used to cost $800 is now hitting $1,500 because genuine parts take weeks to source and labor rates are climbing to cover dealer overhead. And I'm tracking service bills that have doubled in the past 6 months. 992 Generation 911 owner just got quoted $4,000 for a routine transmission service that cost $2,000 last year. The parts shortage is forcing dealers to charge premium prices for components they can actually get their hands on. Extended warranty programs are being quietly revised to exclude coverage that used to be standard. Battery pack replacements on Taycans are getting denied on technical loopholes. Software-related failures are being classified as wear items instead of warranty defects. The fine print is changing faster than owners can keep up. Insurance rates are climbing because repair complexity makes every accident more expensive. A minor fender bender on a Taycan can total the vehicle because replacement parts cost more than the car's depreciated value. Insurance companies are raising premiums across all luxury vehicles to cover these inflated repair costs. Let me walk you through a real case study that shows how fast this crisis hits individual owners. A client bought a 2020 Taycan Turbo S for $185,000 in late 2021. He's now facing a $40,000 loss if he sells today. But here's the kicker. His maintenance costs have tripled while his extended warranty coverage got reduced through program revisions he never agreed to. His charging port failed last month. The repair estimate came back at $8,500 because the part is back ordered and requires specialized labor. His extended warranty is denying the claim because they're calling it normal wear on a 3-year-old vehicle with 25,000 miles. He's stuck with a car he can't sell without massive losses and can't afford to repair. Another owner with a 992 911 is watching his service bills explode. Oil changes that used to cost $300 are now $600 because the dealer can't source OEM filters reliably. His clutch replacement quote came back at $12,000, right? Double what the same job cost 2 years ago. The dealer blamed parts availability and increased labor complexity. The luxury car investment myth just died a violent death. For decades, enthusiasts justified premium purchases by claiming certain models appreciate or hold value better than regular cars. That narrative collapsed when Porsche admitted they can't make money selling 6-figure vehicles. Collector trim levels are getting hammered worse than base models. GT3 and Turbo S variants that used to command waiting lists are now sitting on dealer lots with discounts. The speculation bubble that drove prices on limited production models just burst. Anyone who bought thinking they had a guaranteed investment is about to learn expensive lessons about market reality. The ripple effects are hitting financing options too. Banks are tightening lending requirements for luxury vehicles because depreciation rates make the loans riskier. Lease residual values are getting slashed because nobody knows what these cars will be worth in 3 years. Monthly payments are climbing even as vehicle values crater. But here's what really should scare you. This isn't the bottom. The luxury car market collapse is just getting started. When Porsche, the most profitable luxury automaker, admits their business model is broken, it signals systematic problems that will take years to resolve. Your wallet is about to discover exactly how expensive luxury car ownership becomes when the entire support ecosystem implodes. The damage spreads fast when market leaders collapse. Porsche crisis isn't happening in isolation. It's the canary in the coal mine signaling that the entire luxury automotive bubble is finally bursting. When the most profitable premium automaker in the world admits their business model is fundamentally broken, it exposes systematic rot across every luxury brand. High interest rates are killing financing for $100,000 vehicles. Monthly payments that used to be manageable at 3% interest rates become impossible at 8%. Lease programs that made luxury cars accessible to upper middle class buyers are disappearing as banks tighten lending requirements. The easy money that fueled luxury car sales for the past decade just evaporated overnight. Younger buyers are rejecting traditional luxury for tech-forward alternatives that offer better value propositions. A Tesla Model S Plaid delivers supercar performance for half the price of a comparable Porsche. Chinese luxury brands like Genesis and Polestar are offering premium features and build quality that match German standards without the inflated pricing. The Chinese market abandonment of German luxury is accelerating faster than anyone predicted. Chinese consumers who used to view BMW, Mercedes, and Porsche as status symbols are now choosing domestic brands that offer superior technology integration. BYD's luxury division is producing vehicles with better software, longer range, and more advanced driver assistance systems than anything coming out of Stuttgart or Munich. U.S. tariffs are adding $700 million in cost burden to Porsche operations alone. That's money that has to come from somewhere. either reduced profit margins or higher consumer prices. When luxury automakers are already struggling with profitability, additional tariff costs force impossible choices between market share and financial survival. Comparable build quality and superior customer service at half the cost. The Emperor's New Clothes moment arrives simultaneously across the entire German luxury car industry. The financial pressure is forcing luxury brands to abandon their core principles. Porsche is developing entry-level crossovers. BMW is cutting costs on interior materials. Mercedes is sharing platforms with economy brands. When luxury automakers start compromising on the attributes that justify their premium positioning, they lose the differentiation that supported their business models. Market consolidation is accelerating as weaker brands face acquisition or bankruptcy, and the luxury car market that supported dozens of premium manufacturers is contracting to a handful of survivors who can adapt to new economic realities, brands that can't pivot to sustainable profitability. Well, the ripple effects are hitting every aspect of luxury car ownership. Parts availability is tightening across all premium brands as manufacturers cut supplier orders. Service networks are contracting as dealers can't justify maintaining luxury brand franchises. Extended warranty programs are being revised to exclude coverage that used to be standard. This isn't a temporary downturn that will recover when economic conditions improve. This is structural change that's permanently reshaping how luxury vehicles are designed, manufactured, priced, and supported. The luxury car market that existed for the past 3 decades just ended. What comes next will look completely different. Here's exactly how to protect yourself from this luxury car market collapse. The strategies I'm about to share will either save you tens of thousands of dollars or help you profit while others get crushed by depreciation. If you're thinking about buying a luxury car, wait 3 to 6 months for the next depreciation wave. The current sell-off is just getting started. Porsche dealers are already discounting new inventory, but the real bargains come when lease returns flood the market next quarter. Used luxury inventory will spike as owners panic sell before values drop further. When you do buy, inspect battery health on any EV like your life depends on it. A Taycan and Macan EV battery packs cost more to replace than the entire vehicle will be worth in 5 years. Demand battery capacity tests, charging cycle counts, and thermal management system diagnostics. Most dealers won't provide this data willingly because it reveals how quickly these vehicles become financial liabilities. Current owners need to hold unless you're leveraged or facing financial pressure. Selling now means eating massive depreciation losses that may never recover. The luxury car market won't stabilize for at least 18 months. If you can afford to wait, your vehicle's value might partially recover once the market finds its new equilibrium. Focus on preventative maintenance immediately. Parts availability is tightening across all luxury brands as manufacturers cut supplier orders. Stock up on consumables like oil filters, brake pads, and spark plugs while they're still available at reasonable prices. The part shortage is going to get worse before it gets better. Avoid collector trims and limited production models until the market stabilizes. GT3s, Turbo S variants, and special editions are getting hammered worse than base models because the speculation bubble burst. These cars are not investments anymore. They're depreciating assets that will cost you money every month you own them. Start sourcing OEM parts early if you plan to keep your vehicle long term. Independent suppliers are already reporting longer lead times and higher prices as luxury automakers reduce production volumes. Build relationships with parts suppliers now before the shortage forces prices even higher. Consider extended warranties while Porsche and other luxury brands still subsidize them. These programs are being quietly revised to exclude coverage that used to be standard, but existing contracts are usually honored. Get comprehensive coverage now before the terms get worse or the programs disappear entirely. Smart timing separates enthusiasts from speculators. If you genuinely love driving and plan to keep a car for years, the current market chaos creates opportunities. Dealers desperate to move inventory will negotiate on prices that were non-negotiable 6 months ago. You can get the car you actually want at prices that reflect realistic market values instead of speculation inflated premiums. But if you bought a luxury car as an investment or status symbol, you're about to learn expensive lessons about market reality. Cut your losses now or prepare for years of declining values and increasing ownership costs. The luxury car investment myth is dead. These vehicles are consumer goods that depreciate like any other manufactured product. Financial disaster awaits speculators who thought limited production runs guaranteed appreciation. The market forces that drove collector car values to ridiculous heights just reversed. Easy credit disappeared. Speculative buyers walked away. The artificial scarcity that supported inflated prices evaporated when economic pressure forced reality back into luxury car valuations. And the next 12 months will separate smart money from dumb money in the luxury car market. Smart money waits for better opportunities, focuses on vehicles they actually want to drive, and prepares for higher ownership costs. Dumb money panics, makes emotional decisions, and tries to time a market that's fundamentally changing. Your wallet's survival depends on understanding that the luxury car market of the past 3 decades just ended. What comes next will reward patience, punish speculation, and favor buyers who focus on actual utility over status signaling. The luxury car market is facing its biggest shakeup in decades. The Porsche profit collapse signals systematic changes that will reshape how every premium vehicle is priced, serviced, and valued. Your financial survival depends on understanding these hidden market forces before they crush your wallet. Subscribe for more brutal truth about automotive industry crashes. Hit that notification bell because the next wave of luxury brand failures is already building momentum. Your money depends on staying ahead of these market earthquakes.